Okay, so for this next video lecture, we will be discussing about financial statement assertions. Okay, when we say assertions, these are the representations which are explicit or otherwise with respect to the recognition, measurement, presentation, and disclosure of information in the FS, which are inherent in management representing that the FS are prepared in accordance with the applicable financial reporting framework. So we have been talking about assertions before, and as we've mentioned, these are the representations made by the management which the auditor can see in the face of the financial statements, and that according to the management, it is prepared in accordance with the financial reporting framework, okay, or standards. So these assertions are used by the auditor to consider different types of potential misstatements that may occur when identifying, assessing, and responding to the risks of material misstatements. So this will be the basis of the auditor later on in determining the potential misstatements that may exist in the FS. So the assertions may fall into these following categories. So the first is about the assertions about the classes of transactions and events and related disclosures for the period under audit. So here, this is focused on the transactions uh, and events that should have been recorded and its related disclosures. Okay, so for this type of assertions, so we have first occurrence. So in this case, the auditor will determine if um, the transactions and events that have been recorded or disclosed have occurred in such transactions and events pertains to the entity, meaning those transactions that occurred should be recorded or disclosed. Okay, and most especially if these transactions relates to and are the business transactions of the entity and not of the other parties. And this should also be a recordable transaction or event. Okay, so in this type of assertion, uh, occurrence meaning that whatever is recorded in the books of the entity has actually occurred and is appropriately a business transaction of the entity. Okay, the second type of assertion under this category is completeness, meaning that all the transactions and events that should have been recorded are actually recorded. Okay, and all related disclosures as well that should be included in the FS have been included, meaning um, all the transactions that are recordable and that relates to the entity have been recorded in the books. This is what we call completeness. And there is no any one transaction which are left unrecorded. Okay. Another is accuracy. So in this case, the auditor will determine the amounts and other data relating to the recorded transactions uh, that were recorded appropriately, and related disclosures as well have been appropriately measured and described. So here, the auditor will determine if the transaction were recorded and they were measured appropriately in the proper amount accounted for such transactions. So if you could still remember in your financial accounting, we have the guidelines based on the standards on how to measure a certain account. So this should be determined by the auditor. Another is cut off, meaning all the transactions and events have been recorded in the correct accounting period. So meaning all the transactions that pertains to this current accounting period should be recorded in this uh, accounting period as well, in the books of the entity. And all the transactions that are recordable in the next accounting period should also be recorded in that period and not to be included in the current FS. In this case, cutoff is used especially for preventing window dressing, where the entity opens still their books to include transactions for the next period in the current accounting, or in the current record or books which are not appropriate. Okay. Another is classification. In this type of assertion, the auditor will make sure that transaction and events have been recorded in the proper accounts. So, classification of the transactions according to their nature, okay, on the appropriate account, okay, where they should be recorded. Okay, so that's how it should be in this type of assertion. Okay, another is presentation. So in this case, the auditor will determine if transactions and events are appropriately aggregated or disaggregated and clearly described, as well as their related disclosures are relevant and understandable in the context of the requirements of the applicable financial reporting framework. Okay, so basically, um, following the standards on how to present it in the FS. Okay, so this is how, or this is what the auditor is concerned under this type of assertion in the presentation. So how it should be, it should appear, okay, in the face of the financial statements as well as in the disclosures. Okay, so the next category of assertion are the assertions about account balances and its related disclosure at the period end. Okay, the first one is assertions about classes of transaction and events related to disclosures for the period under audit. The other one is at the period end. Okay, so under this category of assertions, so we have the following assertions: existence. Okay, meaning the assets, liabilities, and equity interest really exists, okay, at the end of the accounting period, where they account it and present it in the face of the financial statements. Okay, for example, if they have presented inventory in the FS or in the statement of financial position, that amount of inventory should also be present in the warehouse or in the premises of the entity for physical accounting to determine if they are uh, what do you call this, they are the same, okay, in terms of amount that is presented in the FS, or any liabilities of the entities are really existing as of that period end. Another assertion under this category is the rights and obligations. So here the entity, the auditor will determine if the entity holds or controls the rights to assets and liabilities are obligations of the entity, because this should be determined so that the auditor will know if the assets are properly accounted for, recorded, and presented, or it, if that asset should not be presented at all, as well as the obligations. Okay. Another type of assertion under this category is completeness. So, meaning all the assets, liabilities, and equity interest that should have been recorded, and all related disclosures that should have been included in the FS are actually included and presented in the FS. Okay, so In the other type of or category of assertion, completeness there pertains to the transactions. Okay, whereas in this category, completeness means um, recording also, okay, of the transactions related to all the assets, liabilities, and equity interests. Okay, another type of assertion under this category is accuracy, valuation, and allocation. So here, assets, liabilities, and equity interests have been included in the FS at appropriate amount, and any resulting valuation or allocation adjustments are also appropriately recorded, as well as its related disclosures. They are appropriately measured and described. So, accuracy as to the measurement, valuation, measurement also, and allocation, okay, of these accounts. Okay, so for example, um, uh, the estimates probably will be included in this case. The expenses, like depreciation expenses, how should it be allocated? The liabilities, okay, and so on. So these are for the accuracy, valuation, and allocation. If it was actually properly and appropriately adjusted or recorded in the face of the financial statements. Okay, another assertion under this category is classification. Okay, so the auditor here will determine if the assets, liabilities, and equity interest are recorded in the proper accounts. So they are classified accordingly based on their nature. Okay, another assertion under this category is presentation. So the assets, liabilities, and equity interest are appropriately aggregated or disaggregated and clearly described, as well as its disclosures are relevant and understandable based on the applicable financial framework. So again, this is how the account should be presented in the face of the financial statements based on the standards. So assertions may also be expressed differently, provided that all aspects described in the previous slides are covered. So, for instance, the assertions can also be categorized as follows. First, assertions about classes of transactions and events for period under audit. So, it can include occurrence, completeness, accuracy, cutoff, and classification. And in the second category, assertion about account balances at the period end. So it can include existence, completeness, rights and obligations, valuations, and allocation. But the point here is that all of the assertions mentioned should be present. So depending on how it should be classified, the point is it should be complete. Okay, it should include all these types of assertions. Okay, another is assertions about presentation disclosure. So they can add and separate these assertions about presentation and disclosure. So they can, or the auditor can include here assertions about occurrence, rights and obligations, completeness, classification, even understandability. Okay, as well as accuracy and valuation. So those are the different categories of the assertions. Okay.